So, presently, the chip sector mostly has higher free cash flows, and you have higher pricing power longer term. But software is substantially more competitive, and this is simply exemplified by Taiwan Semiconductors, which has a 92% massive grasp on the advanced microchip market. Now, of course, the software sector is also getting a lot of negative attention, mostly because of the negativity coming out of the earnings call from Microsoft, which apparently was also suffering technical difficulties, which doesn't help, but also there are substantial downgrades that we're seeing from Wall Street. For example, prior to the Microsoft report application, we had Wall Street reports suggesting that application software companies likely face revenue downgrades ahead of Q4 earnings. Calls several percentage points of growth expectations may be shaved off. Going into 2023, analysts think that average revenue growth rates could come in below 15%, while the current consensus for software is 17 to 18%. Now, Azure Microsoft actually beating expectations. As for the last quarter, their forecast was not so great. In fact, their forecasts for Azure were flat for the next quarter, and forecasts from Wall Street were that future cloud growth would be somewhere between 17 to 18 in aggregate. Now here's consensus estimate and revenue growth consensus estimates calendar period here. Now Bill.com was expecting to have grown double in 2022, but only growing by about 36 to 30% in 2023 and 2024. Now that's not actually terrible. That's actually still pretty dang good into it. Expected to only grow about 8% in 2023. Now it is expected that the server industry will actually do well. Now, downgrades are approaching due to obviously slower commercial seat adoptions or expectations for that slower consumer growth, limited pricing leverage, especially in the Microsoft earnings, which is called PP. Why are you going to see limited PP? Well, because you're going to see Microsoft executives talk about optimizing growth. And that's not them optimizing growth, it's their customers optimizing. And they're going to go through about a 1-year period of optimization, with lengthier sales cycles and slower approval time frames are potentially likely to stall user expansion and limit pricing. Now, they believe that after optimization, they will be able to get back to doing more work. The Power suggests at Bloomberg, the net percentage of business owners expecting the economy to improve is close to all-time lows at negative 51%. And this is likely to weigh on discretionary tax spending. Now, when business confidence is potentially low, it's one of the best times to potentially cannibalize your competition, work harder, and do your best to keep growing. Now, let's go dig that Microsoft earnings call with salient pieces. A few things are increasingly clear. Just as you saw customers accelerate their digital spending during the pandemic, you are now seeing them optimize that spend. That's a red flag, right? Optimizing spend is basically a euphemism for people ain't spending as much money with Microsoft Step Pro. Now, we saw new highs for Game Pass on gaming with game streaming hours and monthly active devices at records surpassing 200 or 120 million devices during the quarter. That's fantastic. And thanks to lower energy costs, they were actually able to increase their margins on Microsoft Cloud, better than expected by 2 percentage points over a year. However, excluding the impact of an accounting estimate, for useful lives whoopsies, Microsoft Cloud gross margin percentage decreased roughly 1 percentage point, driven primarily by a sales mix to Azure. So apparently a little bit of a lower pricing structure there. If you introduce a lower mix, you end up with a lower margin. It's more like during recession, people shift their preferences to spend on commodities of daily use, like a toothbrush, which have less profit margin, as compared to commodities with more profit margin like water gun. Same is the case here. However, Azure shows constant currency growth in the mid 30%. That's looking backward, just wait for the forecast. Alright, now Microsoft tells us in our commercial business, it is expected business trends that we saw at the end of December to continue into January, February, and March. While customers are more cautious in their spend, we also have the opportunity to improve our execution. Given our strong position in global growth markets in commercial bookings, with a declining expiring base, and a strong prior year of comparable sales, essentially for Azure contracts, we expect growth to be relatively flat year over year. Now, unfortunately, the slowdown we saw in December is going to continue in January, and then everybody else is at fault. It's more like the company is still performing and firing on all cylinders, but everybody's just spending less money, and unfortunately, that means instead of being excited about 30% growth from Microsoft Azure, they're actually going to be flat. And given that Bloomberg is pricing in 18 to 20%, or Wall Street potentially is pricing in 18 to 20-ish%, maybe they'll even be negative. Things just ain't that great right now. Okay, that was basic explanation of what Microsoft said. Now, almost the entire software as a services business has rotated down on these Microsoft earnings. This is why, although most of the market is red, here in pre-market, including the solar companies such as FaZe, SunPower, and Sunrun, are all down about 4 to 4.5%. SolarEdge only down about 3%, which is expected to continue. So if you are exposed to solar stocks, expect that sort of pain to continue. However, I expect there to be some opportunities to really increase your share of ownership in solar companies. Once we get to more pain in the real estate sector in Azure, our per-user business should continue to benefit from the Microsoft 365 suite momentum, though we expect continued moderation in the growth rate given the size of our installed base. In other words, thank you law of large numbers, which means once you have so many people on your platform, it's really hard to continue growing, and ultimately, you just hope to keep things stable. In our on-premise server business, we expect revenue to decline in the low single digits. That's a decline of again maybe 3-4%, as demand for our hybrid solutions will be more than offset by the unfavorable foreign exchange impact surge, and advertising excluding total acquisition costs should be in the high single digits, roughly 7 points faster. Now, this is actually good, right? It's reported that advertising spend is up, and you are seeing companies like Carnival Cruise Lines, for example, boost their spending substantially. Right now, they're sailing with the highest amount of potential paying customers. Tech as a percentage of GDP is likely to be higher going forward. So, don't worry, the future is bright for Microsoft within 1 year of pain. So, if you're wondering why we're having some software issues, this could potentially be why. Okay, let's suppose a company provides its 1,000 interns an Adobe Cloud subscription so that way they could use Premiere for editing. Then, let's say you go into a recession and the company lay off 10% hirings and get stuck with just say 900 people instead of 1,000. Well, immediately what you've done for Adobe is you've actually not provided cloud growth. You actually just provided cloud contraction, because by laying off people in a recessionary time, now you further optimize and lesser your cloud subscriptions. So this is a situation where it's basically if you're growing at zero. So basically, if you're a cloud provider and you could keep revenue stable during a recession, you're actually doing good, so as much as Microsoft. 0% growth in a recessionary environment is actually good when it comes to cloud, especially in an environment where there were many tech layoffs. So that's something pretty important to pay attention to. Now, other great question is that, how could this affect the chip market, like Taiwan Semiconductors and AMD? So first, it's worth noting that most of the cloud services provided by Microsoft use hardware, like NVIDIA chips mostly, but also AMD chips. And obviously, a reduction in the expansion in cloud makes us wonder, hey, isn't it possible if cloud spend is going to go down, that chip spend could go down? Now, how we could potentially actually see an acceleration in Microsoft or in chip spend as the demand for a higher quality server accelerates? So, how do we potentially differentiate ourselves from our competitors? Well, unfortunately, the way you differentiate yourself from your competitors is you try to prove that your product is a better product or a faster product or a more capable product, and unfortunately, you do that by refreshing the chipsets that you have in your server industry or your server division. So, well, obviously we expect the chip sector to slow down. There is at least some enthusiasm that as cloud slows down, companies that suffer from those cloud slowdowns are going to be very incentivized to try to get back to growth as quickly as possible, potentially double down on their investments into chips to make that a potential reality. Also, ultimately everything slows down when we go into a recession. Hardware certainly being one of those sectors that is expected to slow down, and a lot of that fortunately seems to have been priced in already. Now, let's talk about Taiwan Semiconductors and Samsung sales. Taiwan Semiconductors and Samsung and other foundries could expect revenue of their advanced packaging business key to producing chiplet-based semiconductors to double by 2025 and become a major growth structure. Chiplet structures are likely to become increasingly popular in laptops, following the introduction of AMD's first chiplet-based laptop semiconductor, and that would be the 5nm chipsets. That's it for today, guys. Hope that you found the video useful. Please hit the like button. Thank you for watching, and see you guys soon.